Ladies and gentlemen, my name is Claudio Grass and I'm the Managing Director of Global Gold in Switzerland. So this is a summary of a presentation I gave on April 28th in Miami at an investor conference. When we look at the actual currency war, it is obvious that this is not the crisis of one currency, but a crisis of the whole fiat money system. History teaches us that there is a clear connection between hyperinflation and the paper currency system. And it is also a fact that the majority of hyperinflations happened in the 20th century. So since 1971, when President Nixon closed the gold window, the actual monetary system is backed by nothing but trust, representing the longest fiat money or paper standard system ever. JP Morgan once said, "Gold is money, everything else is credit." Also, we don't share a lot in common with the Morgans. We truly share his point of view regarding gold. In a credit-based system, we live in an environment where property rights are only of temporary nature. It is our understanding that we are at the beginning of a huge deleveraging phase because there is just too much debt in the system. And we also know that debt is one person's liability, but another person's asset. Therefore, when debt is whipped out, assets will be whipped out as well. In times such as these, you should think about fundamental questions such as, what is money and what kind of characteristics must it have? Is it good that it can be printed out of thin air and forced on us by government legislation? Am I getting richer when more money is chasing the same amount of goods and certain prices rise faster than others, but money itself buys less and less? How solid are the assets I own, and especially how big is my counterparty risk, and what happens when people, companies and governments fail? So this presentation is an introduction into why we believe that direct and unencumbered ownership of physical precious metals stored outside the banking system is essential if you are interested in a monetary insurance against the ongoing problems in our monetary system. Let me be clear. We see the risk of a meltdown of the current paper money system as very real, because this is what history teaches us. Rogoff and Reinhardt said once in this regard that the 5 most expensive words in history have been, "This time it is different." So now let me start the presentation by looking at how money came into existence. As you can see, gold and silver have been money for more than 5,000 years. Even the US dollar became the world currency reserve because it used to be a property title for a certain amount of gold. Now it is just a debt security. The dollar, as well as other currencies worldwide, have transformed from an "I own something" to a "I owe you." Because we believe that history rhymes, we are certain that the dollar and all the other paper money systems are going to collapse eventually. Aristotle came to the conclusion that, in effect, there is nothing inherently wrong with fiat money, provided we get perfect authority and godlike intelligence for kings. I think, however, no one in the audience would argue that neither Obama nor Bush before him come too close to having godlike powers. So to understand gold, monetary history is key. And this is the main page of our homepage, globalgold.ch, and there you will find 2 special reports. I mean, we prepared a detailed monetary history report, real versus false money, which you can download for free, and we also used it as the basis for a micro-documentary how our monetary system works and fails. So I hope you will like it, and I can only urge you to do your home study and learn more about monetary history, because this is really key to understand the monetary system we are in today. So, the dilemma we are in today. This chart from Ray Dalio from Bridgewater Associates. He believes that we are close to a collapse of the current long-term debt cycle. He also believes that we are at the top of a long-term debt cycle. Therefore, it is likely that we will see some deflationary shocks in the future. However, it is our understanding that central banks will try everything to avoid this by printing money to cover up the current problems, which will lead to hyperinflation in the coming years. A deflationary collapse would be a kind of black swan event, which becomes more probable the more the system is centralized. This slide shows debt and the financial system have been completely decoupled from the real economy. It also shows that our current credit-based paper money monetary system induces excessive credit, which can be seen from the fact that credit has increased exponentially since the gold window was closed. So that is the key issue. As this chart shows, most Western countries have piled up a gigantic debt burden. When you take into consideration the unfunded liabilities, the situation seems dramatic. Professor Kotlikoff from Boston University came up with his calculation that the fiscal gap in terms of unfunded liabilities for the US is over 222 trillions, or 13 times the reported 17 trillion in official debt. This shows, the US unfunded, US funded debt. Basically, what we can see is that, in January 1946, the funded debt stood at 260 billion. Today, it's close to 17,500 billion. So, between 46 and 66, the yearly average increase of debt was 3.1 billion. The next 20 years, it went up to 74 billion, so already 25 times higher. Between 86 and 2006, the average increase was 304 billion, representing a 99 multiplicator. And as you can see, since 2006 to today, the yearly average increased by 1,352 billion. So this is 436 times the yearly average between 1946 and 66. Important to understand is that 98.5% of that official debt has been made since 1971, when Nixon closed the gold window. So in the baby boomers' formative years, it took the US government a year to increase their funded debt by 3.1 billion. Today, as boomers retire, it takes the government 20 hours to do the same. So ladies and gentlemen, this is unsustainable. Let's have a look at the consumer inflation. So this slide compares the official inflation rate in red versus the alternative inflation rate in blue provided by Shadow Stats, which is using the same calculation method as the government used back in 1980. You can see that since the middle of the 80s, the blue line is climbing much stronger than the official one. So currently, inflation is at around 8 to 9%, and if we take the actual interest rates in the US into consideration, which stands at 0 to 2%, the real loss of wealth on an annual basis stands at 8%. So which means that the dollar is losing almost 40% in purchase power within the 5 years. Here is the one chart which illustrates the foundation for understanding the events in the coming years. True money supply consists of cash, checking accounts, and no notice deposit accounts. It represents the actual cash and electronic cash in the system that is instantly available for purchases of goods and services. The red line is the exponential growth trend established between 1960 and July 2008, and as we can see, since mid-2002, the true money supply has accelerated at an even faster rate. In other words, money supply growth has even surpassed exponential growth, and we think that this is paving the way for hyperinflation. But where is all this newly created money going to? I mean, where is the inflation? So this slide shows that liquidity is definitely not going into the private sector, as we can see here. As you can see, the monetary base spiked tremendously since the outbreak of our current crisis. Only in Europe it is visible that since last year the monetary base is contracting on a relatively high level. But as you know, Mario Draghi, head of the ECB, reduced interest rates to 0.25% in November last year, and they are talking about injecting 1 trillion of new liquidity into the euro system. This chart just shows that the markets are rigged by the Fed. So this chart shows how our markets are rigged by the Fed. If you exclude the days prior, during and after the FOMC meetings of the Fed, you see that the performance of the S&P 500 would be considerably lower. So 440% versus 170% without the FOMC meetings. Chart 2 shows the velocity of money, which is sinking. So we are not yet seeing any considerable inflation. However, it is visible that the money is flowing into financial assets, such as stocks, and is creating inflation there. Monetary inflation is just propping up the market. This chart shows the market cap of the New York Stock Exchange and the Nasdaq in comparison to the nominal GDP of the United States. As you can see, we are well above most previous levels, indicating that the stock market is overvalued. We saw similarly high figures prior to the dot-com bubble bursting and the subprime crisis. So at the moment we are standing at 144. 2008 we stood at 139. So only 2001, when the dot-com bubble burst, the valuation was higher. So how high can it go? I mean, what we are also witnessing is a political power shift. As we can see, wealth is being transferred from west to east. The US has lost more than 30% of its share of world GDP within 10 years. And I think that says it all. And you can see the same goes, for Japan, 35, Germany even lost 12.8%, UK minus 24%. So we have, China, Brazil, Russian Federation, and the other emerging countries, really gaining track. What about data manipulation? The U3 unemployment rate is the monthly headline number. U6 in gray, unemployment rate is the Bureau of Labor Statistics' broadest unemployment measure, including short-term discouraged and other marginally attached workers, as well as those forced to work part-time because they cannot find full-time employment. Shadow Stats also calculated the unemployment rate using the old US methodology. These figures are nearly 4 times higher than the U3 figures. So data manipulation, anyone with an unemployment rate of nearly 25%, I think it's clear that we are far from any form of recovery. And keep in mind that the unemployment rate at the peak of the Big Depression stood at 20% in the United States, and we are right now approaching 25%. So what kind of jobs are created? Is that on a sustainable path? No. Chart 1, this just shows the trillions of dollars which were pumped into the system were only able to stabilize the unemployment rate, but the job creation is far below what we have seen in previous recoveries. Chart 2 shows that goods are not being produced anymore. Blue line is jobs in the goods producing industry, which is on a record low. And these are, the service providing industries, which is roughly 120 million people. So if you look at the pure manufacturing jobs, which would be 18 million in total, but the pure without management and office staff, then we are talking about 12 million people. So we have less people working in the industry than working for the government. So the US government, for example, employs approximately 22 million people, education and health care another 22 million. And I think it's key to understand that production and savings are the basis of a sound economy and not consumption and debt. So the job market is not recovering and not on a sustainable path at all. I rarely listen to the media, but when I do, it seems everyone has forgotten the crisis and believes the recovery is on track. So let's look at Europe and the United States. So Europe is struggling with very high unemployment rates, especially among the youths. So there is still no light at the end of the tunnel for the south of Europe. In the United States, as I mentioned, I believe that unemployment figures can and are easily manipulated by governments by changing how unemployment is defined. So this is harder, for example, when the figures regarding food stamps, and in the past years, they have seen only one direction, going up. So is the economy picking up? So this slide shows the previous 4 recessions and recoveries from 1973 to 2001. The red line, on the other hand, shows the current recovery. Also, the Fed has injected trillions of dollars worth of liquidity, unprecedented in history. The real economy is still worse off than in every other recession before, and it is not foreseeable that this is going to change anytime soon. In this regard, we should not underestimate the creativity of governments. The US, for example, decided to change the calculation method for the GDP by July 2013. Research and development costs and costs for creating intangible assets such as movies, books, etc. have since then been considered as investments and have been added to the value of the GDP. The effect of this adjustment is $500 billion more, or an additional 3% growth annually than if one uses the old methodology. So this new and improved calculation method will become the international standard and will bring fake growth to Europe as well, starting in September this year. So what had Alan Greenspan to say about gold? In the absence of the gold standard, there is no way to protect savings from confiscations through inflation. There is no safe store of value. The financial policy of the welfare state requires that there be no way for the owners of wealth to protect themselves. This is the shabby secret of the welfare statist tirades against gold. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights. If one grasps this, one has no difficulty in understanding the statist antagonism towards the gold standard. So here we can clearly see that gold is the barometer that indicates that there is something wrong with the fiat currency. So the gold, the Swiss franc is the best performing currency so far, with only losing 90% of its value versus gold since 1971. And the other currencies such as the US dollar lost 97%. Is gold in a bubble? So the blue line shows the bull market starting in 1968 when gold stood at $35 an ounce and went up to $850 by 1980, representing a 20-fold increase. So interestingly, in the last 6 weeks before the crash, the gold price doubled. So the red line reflects the current bull market since 2001 till today, whereby the price has only quadrupled. So this, ladies and gentlemen, is a completely different picture and underlines our conclusion that gold is not in a bubble at all. Also, it might be possible that the gold price could correct in the short term another $50 or $100 within the actual environment. We see this clearly as a historical buying opportunity to increase physical positions. So paper dominates physical. And this is simply incomprehensible to me, especially when one takes into account that there are hardly any physical transactions taking place at the COMEX. However, since the price crash in April last year, it is visible that the physical stock or registered gold stock, which is available to settle open interest contracts, has contracted heavily, as we can see here. For every contract worth 100 ounces, currently 2 ounces are physically available. So it is important to understand that the previous sell-offs were not due to lack of physical demand. The physical gold is being transferred from the west to the east. The people in the east are grasping the opportunity to buy all the metals they can get their hands on at these low levels. This slide shows the official Chinese gold net imports from Hong Kong, and it seems that China's hunger for physical gold is unstoppable. The price volatility is not scaring the Chinese, quite on the contrary. They are buying on the dips and continuously increasing their gold imports. The Swiss refineries, which are responsible for approximately 70% of the worldwide gold refining, are still working 24/7, and they are sold out. Books are full till 2016. So therefore, investors have to look behind the curtain to get the clear picture about what's happening in the gold market. This slide shows, the official sector sales. So basically, central banks became net buyers since 2010. So for many years now, central banks in the West have been the sellers, whereas especially countries in the Middle East, as well as emerging markets such as Mexico, Russia, Turkey, South Korea, but especially China and India have become the buyers. Therefore, we expect that this geopolitical trend will continue with further acquisitions by emerging markets. A final word in regards to gold and how it reacts in a deflationary environment. And I think it's key to understand that deflation means always a flight into monetary equality, and it seeks to eliminate counterparty risk. So John Exter was an American economist and the former central banker, devised an inverted pyramid of asset classes in terms of risk and market size. At the bottom of the inverted pyramid is gold, the asset class with the least amount of risk, but also the least available according to Exter. In a low risk market with positive inflation, money moves up the inverse pyramid away from gold and more towards derivatives and paper markets. Conversely, in a bust, people flee down the pyramid to the safe haven being gold. So we are living in a complex world no one understands, and however we can use history and independent mind and human logic to prepare, for the future. In general, we don't know what might work for the future in a world full of uncertainty, but most of us know for sure what does not work, or in the words of Nassim Taleb, the greatest and most robust contribution to knowledge consists in removing what we think is wrong. Consequently, it can be said that printing wealth out of nothing is nonsense. It can work for a short time, but will always end in a full-scale collapse. So what is the core mission of Global Gold? It is safekeeping. So we store and protect your assets on your behalf, whereby the ownership rights stay with you at all times and are not transferable unless you personally instruct us otherwise. We are not allowed to pledge, hedge, or loan out your metals, nor are they part of our balance sheet. So we guarantee the complete availability one-to-one in the format you purchased the metals until you ask for delivery or decide to sell your metals. The metals are fully yours and at your own disposal at any time. And most importantly, we store outside the banking system and under Swiss legislation. Because we believe the jurisdictions we operate in, Switzerland, is known for its stability, safety, solid rule of law and high service quality. In view of current global economic and political realities, we are convinced that Switzerland is the jurisdiction that most properly guards the interests of our clients and respects their property rights. Ladies and gentlemen, Pericles once said, it's not a matter of predicting the future, but of being prepared for it. Gold and silver should not be seen as a trading vehicle. Instead, you have to look at it as your monetary insurance in a highly uncertain world against the possible crash of the actual monetary and financial system. If you are interested in further information, please visit www.globalgold.ch or subscribe for our quarterly outlook report, which is focusing on gold, the Austrian School of Economics, monetary and geopolitical history by providing special reports as well as book summaries.